Hey there, everybody. This is Bob, a trade genius. Got my good friend Phil with me, back from a long 3-day Labor Day vacation. And we're going to pat ourselves on the back here a little bit. The Federal Reserve now agrees with our recession assessment, not only our recession assessment, but also our inflation assessment as well. This is not good news. Stay tuned. We're going to talk all about the recession and inflation.
Trade Genius.
Hey guys, I'm gonna tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code PODCAST for 15% off the retail price of newsletter. Thanks for listening.
Okay, Phil, I'm going to actually kick it off and show the first two slides, and I'm going to throw this over to you. If you throw this first slide up here, St. Louis Fed has now went negative on their GDP assessment, negative 0.7, which is hilarious because the Atlanta Fed's been calling for 5.5 GDP growth. It's all unraveling right now. And, if you add in what's happening with the oil markets, by the way, for the trolls out there, we've been telling you guys to get long oil since the early 70s in terms of dollars. And now we're hitting 90 on oil, and we'll probably go triple digits before the whole thing unwinds. So This is not good news. The market can't absorb it. Recession's coming. And here's the other thing too, which is maybe good news a little bit, maybe some relief coming, Phil. If we go to the second slide, you can see how tight we've been here. When you look at the real rates here, we're at 290 basis points above what they would call fair value based on where the inflation rate is. So we really have positive real rates. And you can see Japan has negative real rates. That's what's been holding the markets up, that and Janet Yellen. And at some point, we're going to probably be like Japan, Phil, is that the market's not going to be able to absorb all this interest charges. And we're going to see a point where J-Powell is going to have to relent. And for me personally, Phil, I think this is why the market's been holding up, is that they're expecting the Fed to pivot, and I think he's trying to just wash them out before he makes the move down. I'm going to throw this back to you, and I think you have some really cool charts talking about basically prices and inflation and pretty scary stuff.
So, I think I agree with you on the macro, and I think we are pretty close to done raising rates. Maybe we get one more quarter point, maybe, but I think they're going to be content on potentially looking at another skip. And the wording there is going to be important too, Bob, in the upcoming FOMC meeting, because whether they say skip or pause, last time they said skip, meaning that they're not done, they're just not going to raise that round. But if they say pause, that is to me them telling you and I that we probably are going into a recession. So that'd be very interesting wording going into FOMC. But carrying on to the next chart, we have some just glaring things that stand out at us. 40% of all US adults have less than $1,000 savings. I mean, that is atrocious, Bob. And we've shown you guys time and time again that the retail sector is just hurting. And here's a big chunk of why. People don't have discretionary income. We were benefiting from a lot of handouts, and a lot of people had a big boost in savings from the COVID crisis and all of that free money that went into the system. But it was a double-edged sword. Yeah, a lot of people just decided to go take a vacation instead of staying home, but it also drove up inflation. And now all of that's been depleted. And I think they were projecting that by the end of October, most of the excess COVID savings that people had enjoyed will be wiped out, which means that this economy is not really running on its own. It's not standing on its own 2 feet because people aren't making enough money to get ahead. And that's the problem with handouts, is that they're short-lived and ultimately you have longer-term effects that you need to reconcile. So not good there. If we look, Bob, I'm going to go to the change in prices because that kind of goes along with what we're talking about. Then we'll flip over to that mortgage one that you wanted to show. But if we look at the stuck inflation, we've been telling you guys this too. These guys are championing the fact that they're getting closer to 2% inflation, which that's fine if that's what you've been dealing with year over year. That's the expected growth of inflation. It's moderate. and it's easily dealt with. The problem here, though, if you guys look at the price changes since COVID since 2000, is that, the things that really matter, your healthcare, your education, your housing, all of that stuff is just unrelenting, and it's just been going up over and over and over again, year after year, decade after decade. I mean, look, you can see the percentages there. I mean, you're well over 50%, 100%, up to 200% as far as healthcare. And the things that don't really matter, this is what I call the stuff on the bottom is let them eat cakes category, right? Because as long as you're keeping the consumer and the general population fat, dumb, and happy, you can get away with a lot of stuff. And because a lot of what's happening here benefits the 1%, right? And you're creating this larger divide. So, people that are enjoying cheap televisions and cheap cell phones, are getting decimated though in terms of wealth inequality. So, I always get a little bit upset, let's say, when the Fed is out there, trying to do a victory lap on this goal of getting towards their 2% inflation target, when in reality, they need to concentrate on getting some of this stuff back down into what we need to see is deflation. And the market, if you read the financial textbooks, deflation is it's like HIV for the economic markets, right? Because it's just like it can spiral out of control and you have all these historical examples. But in reality, we really do need some deflationary cycle stuff to happen because this is unsustainable. And I think we're going to go into more of a macro look here on the mortgages and unemployment here with your next slide, Bob. But I don't see any other way other than get into a couple deflationary cycles here and get things back into a more realistic spot for most of the people that are in the working class.
I totally agree with you. The Fed has a problem now because they can't get food prices down in aggregate and they can't get energy prices down.
Right.
And we talked about that. I mean, you and I talked about that, Phil, in 2006, 2007,
Sure.
Is that the Fed will no longer be able to do anything if they can't control those. Well, I think they officially lost control of the energy markets now, probably for a good long while, because of the production falling everywhere.
Right.
And food's going to follow. We're going into a El Nino year, which is going to cause all kinds of disruptions. Basically, Australia is a wheat producing country. It's going to be in a major drought. So I think it's going to become problematic for the Fed. But here's the one that everybody really needs to watch. This is the one that's going to move the Fed off the needle. This and unemployment. So mortgage defaults, unemployment go together, and then unemployment goes with the Fed. And as unemployment starts to creep up, you're going to see mortgage defaults. It's going to cause the Fed to panic. And I think that's what actually is going to break the Fed's stranglehold on trying to hold these rates higher for longer, Phil. And I just want to just throw this out. Look at the guys, you want to look at data that's coincident or it's precedent. Okay. Those are the ones that are going to help you predict where you want to be pushing your money or pushing yourself out of these markets. And this is another one to keep an eye on because as unemployment goes, the defaults go. We had the highest August bankruptcies in the nation's history, Phil, last month. And so I think it's just a matter of time before we get a massive break. And I don't think it's going to be simple. Look at these moves. These moves are elevator-like in terms of when they go, they're just, what happens is they suppress, and then they let it go. Just like they did with unemployment this last report.
Yep. Yeah, and if you look at this chart too, Bob, it oscillates, right? You get toward 5%, 4%, and there's some systemic event that, like you said, uncorks it. And we're there now. We're really deep there now. And it reminds me of a lot of the recessionary metrics that we've shown you guys in terms of manufacturing and retail and things like that. Deeply recessionary prints. Manufacturing PMI the other day we showed you guys was below 47, which almost always, with rare exception, almost always dives you into recession. So yeah, Bob, I think the most important data points coming out now is going to be GDP quarter over quarter and unemployment. And I think once unemployment starts cracking back over 4%, I think you got to buckle up because I think that's going to bring 5% and higher, and it's going to come quickly.
Totally agree. And don't listen to anything on CNBC. They lowered the recession percentage down again. And then somebody on Twitter, which is the greatest place in the world to find fake information, they said in 2008, they said we're going into a soft landing. So don't listen to these guys. They're professional liars. Just watch the data.
That's right. All right, guys. Well, let us know what you think about this data we presented to you. How do you feel about the effects of inflation? Do you think it's getting better or do you think it's getting worse? And let us know your thoughts about the macro picture here where do you think we're going into the middle of 2024? That's what I want to hear from you guys. So if you let us know that, that'd be awesome. Otherwise, check out our specials over at tradegenius.co, and also check out our channels, hit subscribe, hit like. We really appreciate that stuff. Helps our channel grow and helps us keep giving you this content. Thanks guys. Thanks Bob. We'll see you guys on tomorrow's video. Take care.
Trade Genius.